As a U.S. expat, you may wonder how to determine your tax residency status and what are the benefits of being a bona fide resident or a physical presence test filer. In this video, we will explain these concepts and how they affect your U.S. tax obligations. First of all, you need to understand that the U.S. taxes its citizens and permanent residents, green card holders, on their worldwide income, regardless of where they live or work. This means that even if you move abroad, you still have to file a U.S. tax return every year and report your foreign income, assets, and accounts. However, there are some exceptions and exclusions that can help you reduce or eliminate your U.S. tax liability as an expat. One of them is the Foreign Earned Income Exclusion, FEIE, which allows you to exclude up to $108,700 of your foreign earned income from U.S. taxation, and another one is the Foreign Tax Credit, FTC, which allows you to claim a credit for the taxes you paid or accrued to a foreign country on your foreign income. To qualify for these benefits, you have to meet one of two tests: the bona fide residence test or the physical presence test. These tests are different from the tests that determine your residency for immigration purposes. Let's see what they entail. The bona fide residence test requires you to establish that you have a genuine and permanent home in a foreign country and that you intend to remain there indefinitely. You also have to be a citizen or national of the U.S. who is a resident of a foreign country for an uninterrupted period that includes an entire tax year, January 1st to December 31st. You cannot have any plans to return to the U.S. in the near future or maintain any ties that indicate your presence abroad is temporary. The physical presence test requires you to be physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months. A full day means 24 hours, so you cannot count partial days or days when you travel to or from the U.S. You also have to be a citizen or national of the U.S. who has a tax home in a foreign country during the period of physical presence. Both tests have some exceptions and limitations that may affect your eligibility. For example, you cannot use the bona fide residence test if you are an employee of the U.S. government or if you are present in a foreign country in violation of its laws. You also cannot use the physical presence test if you are present in a foreign country because of military orders or if you are present in certain countries designated by the president as combat zones. The benefits of being a bona fide resident or a physical presence test filer are that you can claim the FEIE and FTC for the entire tax year, regardless of when you start or end your foreign assignment. You can also use these tests to qualify for other exclusions and deductions related to your foreign housing expenses, moving expenses, and business expenses. However, being a bona fide resident or a physical presence test filer does not mean that you automatically lose your U.S. tax residency status. As we mentioned earlier, if you are a U.S. citizen or permanent resident, you are still subject to U.S. taxation on your worldwide income and reporting requirements. You also have to file a Form 2555 with your tax return to claim the FEIE and FTC and show that you meet one of the tests. If you want to end your U.S. tax residency status as an expat, you have to renounce your citizenship or abandon your green card. This is a serious decision that has legal and financial consequences. You may have to pay an expatriation tax if you are considered a covered expatriate under certain rules. You also have to file a Form 8854 with your final tax return to certify that you have complied with all your U.S. tax obligations for the past 5 years. As you can see, determining your tax residency status as a U.S. expat and what are the benefits of being a bona fide resident or a physical presence test filer is not a simple matter. It depends on many factors and circumstances that may vary from case to case. That's why we recommend that you consult with an expert like Arif Patel, who can help you navigate the complex U.S. tax system and optimize your tax situation as an expat. One of the challenges of being a U.S. expat is dealing with taxes. Not only do you have to file a U.S. tax return every year, but you may also have to pay taxes to the country where you live and work. Fortunately, there are some ways to reduce your U.S. tax liability and avoid double taxation. In this section, we will talk about how to use the Foreign Earned Income Exclusion (FEIE) and the Foreign Tax Credit (FTC) to save money on taxes as a U.S. expat. The FEIE is a tax break that allows you to exclude up to a certain amount of your foreign earned income from your U.S. taxable income. Foreign earned income is income that you receive for services performed in a foreign country, such as wages, salaries, commissions, bonuses, and self-employment income. It does not include passive income, such as interest, dividends, royalties, pensions, or Social Security benefits. To qualify for the FEIE, you must meet two requirements. Your tax home must be in a foreign country, and you must either be a bona fide resident of a foreign country for an entire tax year or be physically present in a foreign country for at least 330 full days in a 12-month period. You can use Form 2555 or Form 2555 Easy to claim the FEIE on your U.S. tax return. The amount of the FEIE is adjusted annually for inflation. For 2022, the maximum amount is $112,000 per person. If you are married and both you and your spouse qualify for the FEIE, you can each exclude up to $112,000 of your foreign earned income. However, if you elect to exclude any of your foreign earned income, you cannot take a foreign tax credit for the same income. The FTC is another tax break that allows you to reduce your U.S. tax liability by the amount of foreign income taxes that you paid or accrued to a foreign country or a U.S. possession. Foreign income taxes are taxes that are imposed on you by a foreign country or a U.S. possession based on your income. They include income taxes, war profits taxes, and excess profits taxes. They do not include property taxes, sales taxes, value-added taxes, or Social Security taxes. To qualify for the FTC, you must meet three requirements. The tax must be imposed on you by a foreign country or a U.S. possession. You must have paid or accrued the tax, and the tax must be legal and actual. You can use Form 1116 to claim the FTC on your U.S. tax return. The amount of the FTC is limited by your U.S. tax liability on your foreign source income. Foreign source income is income that is derived from sources outside the United States, such as interest from a foreign bank account, dividends from a foreign corporation, or rent from a foreign property. You cannot use the FTC to reduce your U.S. tax liability on your U.S. source income. You can choose to take either the FEIE or the FTC for each type of foreign source income that you have. For example, if you have both foreign earned income and foreign passive income, you can take the FEIE for your foreign earned income and the FTC for your foreign passive income. However, you cannot take both the FEIE and the FTC for the same type of foreign source income. By using the FEIE and the FTC strategically, you can lower your U.S. tax bill and avoid paying taxes twice on the same income. However, these tax breaks are complex and have many rules and exceptions. Therefore, it is advisable to consult with a tax professional who specializes in expat taxes before filing your U.S. tax return. If you are a U.S. expat, you may have to report your foreign bank accounts, assets, and income to the U.S. government using different forms and rules. In this section, we will explain how to report them using the FBR, FATCA, and Form 8938, and what are the penalties for non-compliance. The FBR stands for Foreign Bank Account Report, and it is filed with the Financial Crimes Enforcement Network, FinCEN. Using form, you have to file an FBR if you have a financial interest in or signature authority over one or more foreign financial accounts that have an aggregate value of more than $10,000 at any time during the year. Foreign financial accounts include bank accounts, brokerage accounts, mutual funds, trusts, or other types of foreign financial accounts. The FER is due by April 15th of each year, but you can request an automatic extension until October 15th. The FATCA stands for Foreign Account Tax Compliance Act, and it is a law that requires certain foreign financial institutions to report information about their U.S. account holders to the IRS. If you have an account with a foreign financial institution that is subject to FATCA, you may receive a request from them to provide your name, address, taxpayer identification number, and other information. You should comply with their request to avoid any withholding or penalties. Form 8938 is part of the FATCA law, and it is filed with the IRS along with your U.S. federal tax return. You have to file Form 8938 if you have specified foreign financial assets that exceed certain thresholds. Specified foreign financial assets include foreign financial accounts and other foreign assets such as stocks, bonds, contracts, interests in foreign entities, etc. The filing thresholds vary depending on your filing status and whether you live in the U.S. or abroad. For example, if you are a single U.S. expat living abroad, you have to file Form 8938 if your specified foreign financial assets are more than $200,000 on the last day of the year or more than $300,000 at any time during the year. Form 8938 is due at the same time as your federal tax return, including extensions. It is important to note that filing Form 8938 does not exempt you from filing an FBR and vice versa. You may have to file both forms if you meet the requirements for each one. Failing to file either form can result in severe penalties. For example, if you fail to file an FBR, you may face a civil penalty of up to $10,000 per violation or a criminal penalty of up to $250,000 or 5 years in prison or both. If you fail to file Form 8938, you may face a civil penalty of up to $10,000 per violation or a criminal penalty of up to $50,000 or 5 years in prison or both. Therefore, it is essential that you keep track of your foreign bank accounts, assets, and income and report them correctly using the FBR, FATCA, and Form 8938 if you are required to do so. If you need help with filing these forms or understanding your obligations as a U.S. expat, you can contact Arif Patel for expert advice and assistance.